Good afternoon, and welcome to the Construction Economy Outlook Spring 2024 edition from Construct Connect. This webcast series is produced in collaboration with the American Institute of Architects and the Associated General Contractors of America. I'm Paul Hart with the Economics Group here at Construct Connect, and I'll be your moderator for the program today. We're very glad that you've chosen to join us. Once again, we are very fortunate to have a panel of top experts on the North American construction economy. Here's what we're going to be covering over the next 90 minutes or so. We'll begin with Kermit Baker, the chief economist for the American Institute of Architects. Kermit will share his thoughts on recent trends in construction spending, headwinds facing the commercial construction real estate sector, and of course, the latest results from the Architectural Billings Index, the ABI. Ken Simonson, chief economist at the Associated General Contractors of America, will walk us through the latest construction employment numbers and help us understand important changes in the cost of construction he's tracked since our last session in November. ConstructConnect's Vice President for Content Acquisition, Morgan Stinson, will review recent trends we're seeing in volumes of new bidding projects in the US and Canada. Then it will be time to dive right into our brand new Construct Connect starts forecast that we just issued earlier this week, and the report is out now today. We'll cover that with Michael Gukas and Alec Carrick. Michael will review the starts outlook for the US and Canada, as well as project stress conditions and the recent impacts to the build versus buy equation, while Alec will provide details on construction start trends at the state and local levels. And then we'll wrap up our time together with a short Q&A session where our panelists will answer questions directly from you. So please feel free to ask a question of our panelists at any time using the Q&A feature on your webcast screen. We will answer as many of your questions as possible in the last 15 minutes of our session here, so don't be shy. The more questions we get from you, the better. If you're having any technical problems or need assistance, please use the chat feature on your webcast screen. Let's keep the Q&A feature for the questions that you want to ask our panelists and the chat feature for any technical issues or any questions you may have for our Construct Connect production team. You may also be asking if a recording of this webcast is going to be available. Yes, absolutely. We will post the recording of this webcast and the slide deck from this presentation on the economic resources page at constructconnect.com in just the next few days. We'll share a link to that site later in the program, and we'll also be posting a copy of the slides during the program as well, again, later towards the Q&A session of our program. So we're trying something a little new today. You should now see a tab, or shortly see a tab at the top of the chat panel that says polls. So please click on that tab and answer the first of two poll questions we're going to be asking the audience today. We'll share the results at the start of the Q&A portion of our program. So look for that polls tab or the little window there and answer our first poll question, and we'll share results later in the program. We are once again proud to say that this webcast is registered with the American Institute of Architects for continuing professional education. All AI members attending this live broadcast are eligible to earn 1.5 continuing education learning unit credits. If you submitted your AIA member ID number when you registered, the record of your attendance will be submitted to the AIA, and they will take it from there. Okay, taking a breath, let's get started. Now, our first panelist to present today is Kermit Baker, the chief economist for the American Institute of Architects in Washington, D.C. As chief economist, Kermit analyzes business and construction trends for the U.S. economy and examines their impact on AIA members and the architectural profession. He originated the AIA's Work on the Boards survey, a monthly assessment of business conditions at architecture firms, and the source of the widely followed Architectural Billings Index. Dr. Baker also served as the project director of the Remodeling Futures program at the Joint Center for Housing Studies at Harvard University from 1995 into 2021. And in 2002, Kermit was made an honorary member of the American Institute of Architects. Welcome back to our program, Kermit. We're so glad you could join us again today.
To welcome our webcast guest today. As Paul mentioned, I'm gonna cover three topics. The first one is recent trends that we're seeing in construction activity. The second is business conditions at architecture firms, and the final one is the construction outlook for the remainder of this year and into 2025. So let's dive right into the numbers here. A big table of figures looking at construction spending for the year in 2023, and it was a very strong year for construction last year. Spending, as you can see, was up in excess of 20%, almost 30% for the commercial industrial side, about 10% for institutional. Particularly on the commercial industrial side, there were just a few key segments that were driving that growth. In particular, the lodging number was very strong, almost 20%. Manufacturing really kind of off the charts with 70% growth. And then on the institutional side, much more uniform in terms of the growth rates. Most of the sectors were in the high single digit or low double digit rates. Next slide. These are the same tables, same sort of numbers for the first 3 months of 2024. So kind of how this year is starting out. Those are the most recent numbers we have through March of this year. And you can see overall spending still pretty healthy at 15%, down from 20% last year. Commercial industrial is flagged a little bit at 15% when it was up to almost 30% last year. Institutional, on the other hand, a little bit stronger, moved from 10% to 15%, as you can see. I've got a couple numbers circled here, kind of focus on the areas that are a little bit weaker and the areas that are a little bit stronger. So on the weaker side in commercial industrial, lodging, that was up 20% last year, now only up less than 1% through the first 3 months of this year. Manufacturing, still a very healthy number, but down to 30% growth from 70% growth in 2023. On the institutional side, education strong, went from 13% up to almost 20% now. Religious and public safety, also strong growth, but much smaller numbers. Education is the largest institutional sector, so certainly the growth in that sector means a lot in terms of spending throughout the construction industry. Next slide. The weakness that we're seeing in many commercial sectors is raising concerns that we may be in for a broader meltdown. So we've seen steep declines in commercial property values in most markets. I'll talk in a bit more detail about that in just a minute. Currently, about 30% of paid work days are worked remotely, and this year has been fairly stable for quite some time. Doesn't seem to be moving down anytime soon. So it looks like it's sort of stabilized at that 30% working remotely. National office vacancy rates are near their all-time high. We haven't really seen the bottom yet. Many office leases have not yet come due in the current environment. There's going to be quite a shock as they do come due. As loans come due, payments will need to increase, although we're seeing a lot of extend and pretend, as it's called, just sort of moving forward on current leases to avoid the problems that they might present. And that really only serves to kick the can down the road. So we're still going to be dealing with that in the future. We could see a growing number of loan defaults, which disproportionately impacts smaller community banks, and they seem to be at risk now too. So the market has coped with these conditions so far, and hopefully will continue to, but there are still some serious risks out there that we're going to be dealing with. And the next slide looks at inflation in construction costs, and that remains a big concern. So inflation in inputs to construction is currently just about flat as compared to year ago levels. Key inputs into construction, lumber, steel, copper, plastics, glass, all are negative relative to year ago levels. Salaries and services, the yellow bars in the middle there, are still trending up and are likely to continue to trend up. So the commodities numbers, the red bars, are going to fluctuate a little bit, some plus, some minus. Overall, I don't think we're going to see much change in those moving forwards. Wages and salaries are likely to continue to trend up in coming months. So all told, probably we are going to see some increase in construction input costs. I'm guessing it's going to stay in the low single-digit range for the time being, though. Next slide. And so, construction costs have been relatively stable over the past year, as we saw in the prior slide. They are well above levels they were at the onset of the pandemic. So when the pandemic hit, we saw construction activity pause. We saw prices hold pretty stable. And then they began to accelerate beginning around mid-year 2021. And so for 2021, the year as a whole, we saw input costs increase by more than 15%. In 2022, that pace of increase accelerated a bit more to about 17% before beginning to level off starting early last year. So they are flat now, as I mentioned, but as you can see, they're up kind of 35 to 40% relative to pre-pandemic levels. And I think the likelihood of going down any time soon is very, very slim. Next slide moves on to our Architecture Billings Index. That's the initiative that the AIA has undertaken for almost 30 years that tracks business conditions at architecture firms. And our analysis concludes that the ABI leads construction activity by around 9 to 12 months, and it's got a very high degree of accuracy. So what are we seeing with our Architecture Billings Index recently? Well, it's been fairly weak since mid-year 2022. And while there were some hopeful signs recently, the most recent release, the March number that we released a couple of weeks ago, was really quite disappointing. So it doesn't appear that we're going to see a broader recovery in design activity anytime soon. And the next slide, again, sort of shows the number, but we're going to compare it to some other indicators, which didn't fall as much in March, but also didn't show any signs of likely improvement in the near term. So new design contracts, that's the teal bar there. That's new project work coming into firms. That's been quite flat recently, basically what it's been since late 2022. And then the yellow line is inquiries for new projects, and they remain modestly positive. They're above the 50 line. The 50 is no change. But basically the trend for this indicator for the last 6 quarters has been fairly flat, so no real increase. And the next slide looks at our Architecture Billings Index on a quarterly basis for the various specialties that we track with our monthly survey. The first one, multifamily residential, that as well as commercial industrial, both reporting fairly weak conditions recently. While firms that concentrate in the institutional market are basically holding their own. You see those numbers just hover very, very much around 50. So commercial industrial firms are seeing conditions soften even more recently. You see that those quarterly numbers falling off. Multifamily firms that did see some of the weakest conditions over the last couple of years, looks like they may be beginning to see a bottom, and optimistically we may see some improving conditions among those firms in the coming quarters. And I've got another piece of information in just a minute to kind of support that. The next slide moves on to our outlook, and one key indicator of future demand in the commercial sector is the trend in property values. So these are numbers, monthly numbers that come from Real Capital Analytics, and they track property values in this commercial category. And they report that the downturn in commercial property values is easing somewhat. So this all types number that is negative over the last year, that number is getting smaller and smaller as the slowdown kind of eases a bit. And we're seeing that particularly in the apartment and retail categories, both of those still negative, but those negative numbers have been getting smaller in recent months. Office properties, just the opposite, large annual declines in office properties, and those numbers have been accelerating recently. And industrial properties are the one category where values continue to increase. And on the next slide, I'm going to kind of walk you through these from a longer perspective. So let's, I think putting these recent numbers in context gives us a better sense of where they might be headed. So this is the all property index, seems to be stabilizing in levels that it was heading into the pandemic, has been easing a little bit, but easing off of some reasonably healthy growth. And then the next line looks at the apartment index. Again, that's been declining, but off of a very sharp run up in the early years of the pandemic. Next line is retail. Retail hasn't seen as much of a decline, but also didn't see much of a run up during the early days of the pandemic. The next line is industrial. As I said, that's been really just going up, flattened out for a little bit, but now it's accelerating again when all the other sectors are going down. And then finally, the apartment index, seen steep declines, but hadn't seen the run up in recent years. So those declines are coming off of not much gains. And if you look, you can see that the prices, index prices for office buildings are back to and even below where they were in 2006. Next slide. These are recent results from a survey that the real estate firm CBRE did fairly recently, and it surveyed investor intentions. And it indicates that multifamily properties are at the top of the investor preferred list for this year. 75% of respondents saying that was one of the sectors they were targeting. Certainly suggests that multifamily projects are likely to begin to recover in the near future after a fairly steep downturn. Industrial and logistics, reasonably healthy still in investors' eyes. Probably not a surprise that offices are the weakest sector in the eyes of investors. And then finally, let me end up with the forecast. These are numbers from the AIA's consensus construction forecast. We publish these numbers twice a year, and they're compiled from the leading forecast firms across the country. These results I'm showing here were released in mid-January. What was their outlook for this year and next year as of earlier this year? Well, after strong growth last year, as I mentioned, very strong growth in 2023, forecasters are predicting a fairly dramatic slowdown this year and next. Overall spending on non-residential buildings is projected to increase a mere 4% this year, only 1% in 2025. These numbers are not adjusted for inflation, so real growth would be even lower than that. The commercial sector is expected to see no growth. Manufacturing, healthy growth this year for projects currently in the pipeline, currently under construction, and then spending stalling next year to no growth. And institutional, certainly by comparison, doing better than the others, only modest growth, low to mid single digit this year and next, but at least one sector that looks to have some increase in construction activity moving forward over the next couple of years. Let me leave it there, Paul, and go back to you.
Thanks so much, Kermit. Fantastic information as always. Always look forward to these, especially jumping into the ABI results. Let me remind everyone that we would love to get questions from you that we can share in our Q&A session at the end of our program after our presenters. Use the Q&A panel on your window in the webcast dashboard. So use the Q&A for questions you would like to ask our panelists, and keep using that chat function to communicate with other attendees, or if you have questions for our Construct Connect production team. So Q&A questions are just for our panelists, and we'll get to those later on in the presentation. Secondly, speaking of questions, our second and final poll question for today is now posted. Look for the polls window that should have just popped up in your screen. Please answer that question as I introduce our next panelist, and we'll share that information again in our Q&A session at the end of our program. Our next panelist is Ken Simonson. Ken has been chief economist for the Associated General Contractors of America, leading trade association for the construction industry since 2001. He has more than 40 years of experience analyzing, advocating, and communicating about economic and tax issues. Among his outside activities, he advises the Census Bureau on overhauling its construction data. He is a fellow and past president of the National Association for Business Economics, and he is co-director of the Tax Economists Forum, a professional meeting group he co-founded in 1982. Great to see you again today, Ken.
Well, glad to be back with you. Let's move on to what's happening with construction employment, and then I want to get into materials cost availability and where I think different segments are headed. The first slide here shows that non-residential construction employment has been growing very strongly for the past year and a half. Most recently, about twice as fast as total non-farm payroll employment, shown by the green line. But the surprise in this, I think, is that residential employment has actually been positive on a year-over-year basis throughout the whole time period. It certainly slowed down a lot from the torrid growth of early 2022, but it's still beating the total non-farm payroll employment growth. However, that really indicates that contractors are having trouble finishing up multifamily projects while the single family is starting to grow. I'll say a little more about that later, but let's get on to a picture of where the growth has been occurring in employment. These figures come from the Bureau of Labor Statistics. They get updated 2 weeks after the national employment figures. So at the moment they lag by a month, but they're pretty consistent from month to month. The year-over-year change has been positive in 39 states from March of last year to March of this year. And the colors do dance around a little bit. There's no great regional pattern, although more weakness in the Northwest and the Northeast. The strongest growth has been consistently throughout the South and the Inland West. Looking at the next slide, we can see that the industry is still facing a challenge of finding enough workers. Here, the blue line shows the number of job openings on the last day of a month, in this case, March, every year from the beginning of the series in 2001. The red line shows the number of people hired during the month, and that you would expect would be much greater than the number of openings on a single day. That was true from 2001 until around 2019. But in the last few years, job openings have continued to rise most of the time, while hiring has more or less stagnated. And as a result, the industry has almost as many openings, or some months more openings at the end of the month than it was able to fill during the month. So I think contractors wanted to hire twice as many people as they were able to find, and more of those states would have been in green or brighter green than you see. Well, let's move on to construction wages. This is a series that comes out with the employment report called the job openings. Called average hourly earnings for production and non-supervisory employees. And it's a long-winded way of describing wages paid to most craft workers and office workers who aren't supervisors. From 2000 through 2019, that average hourly earnings for production workers in construction was 20% or more greater than it was in the broader private sector. That really was how the industry was able to attract and retain workers who had to show up in all kinds of weather, stay in not the most pleasant working conditions in some cases, and get there earlier than I like to get up in the morning. Well, at the beginning of the pandemic, when so much activity was shut down, so many of us were cooped up at home, the restaurants and delivery companies and warehouses that we were buying from, they raised their starting pay in order to get enough workers. And that pay had been as low as minimum wage or even less for tipped restaurant employees. So the floor came up and the premium that construction was paying shrank. It's slowly being restored, but it's still only back up to 19%. So I do think construction wages are going to have to go up even more this year in order to compensate for the decline in attractiveness of construction relative to other jobs that can be done remotely or on a hybrid basis with flexible hours. In fact, on this slide, you can see that average hourly earnings have consistently been rising about 5% over the last several years in construction, whereas nationwide, the average hourly earnings for production workers are now rising only about 4%. I know Kermit had a slightly different measure of wages that was lower. This is specifically for those craft workers and other non-supervisory workers. And my guess is that we will continue to see at least a 5% increase this year, perhaps even greater as we go through 2024 and into 2025. Well, here the red line shows yet another series from the Bureau of Labor Statistics, the Producer Price Index for inputs to new non-residential construction. That's a weighted average of all the materials and services such as design and trucking services used in construction. And it's had a much more volatile course. At the very beginning of the pandemic, it actually declined compared to a year earlier as so much of the economy shut down. But then immediately it started rising very sharply with record prices for lumber, steel, and copper, and very frequent and much steeper than usual increases for items as diverse as concrete products, gypsum, and insulation and plastic pipe. By the last spike occurred after Russia invaded Ukraine in early 2022. And then from June of 2022 through most of 2023, prices moderated. For a few months, they even dipped below that zero line, meaning that they were lower than they had been in the same month of 2022. Just in the last few months, they've moved up again, but only about 1.5%. Now, going forward, I think that we will see gradual acceleration of materials costs, not across the board and not into double digits, unless we have some extreme event happening. But I am worried about cement shortages that showed up in 2022. We're already seeing fairly steady increases in cement prices. And more recently, wall insulation has been very difficult to get if you're looking for mineral wool insulation. And those prices, I think, are also rising. The biggest problem with the supply chain has been with electrical equipment, specifically switchgear and transformers, and in some cases, the electronics for elevators or HVAC or security systems. And these problems look like they're also going to continue through this year. Well, let me move on to a comparison of the prices that contractors are facing versus what they've charged. And the blue line comes from a series called the Producer Price Index for New Non-Residential Building Construction. BLS creates this by asking a group of contractors what they would charge to put up a particular building. And you can see that those bid prices stayed flat all the way through 2020, even as the input costs, shown by the red line, were soaring. Over the next 2 years, the bid prices almost caught up, but lately the bid prices have been flat again, while the input costs have been rising. So as the next slide shows, we can expect a lot of volatility, or at least we can't predict how soon the bid prices will match the input costs. But given that I expect input costs for materials to be rising from, say, 3 to 5% this year, and the labor costs for those production workers up 5 to 7%, at some point, bid prices will have to be going up once more. Well, one last look at what's happened to materials costs is shown by the next slide. Cement prices, as I said, which used to rise only once or twice a year and then slip back sometimes later in the year, up 5% in the last 12 months. And that's been pushed through to ready-mix concrete, up 7%. On the other side, diesel fuel down more than 6%, but just a few months ago, that was rising at a 30% year-over-year rate at the producer level, that is to say, the refinery or the terminal rack. So the takeaway here is that prices can be very volatile for individual items, even when the overall indexes remain pretty calm. Well, let me go on to where I think construction spending is headed. This is a series that the Census Bureau updates on the first day of each month. And you should see everything here in the black, meaning growth from March of 2023 to March of 2024, for projects put in place. We'll get a different perspective in a minute from the folks at Construct Connect. But let me dig into this a little more. The next slide shows some of the 160 categories that the Census Bureau puts up on its website. And again, most things in black, but some of the subcategories have been in red. And also there are a couple of surprises in here. For instance, office construction appears to be up, but that's because office up till now includes data centers. I'm finally able to report that the Census Bureau has paid attention to my complaints and many other folks, and they will be showing data centers separately with their May report that will come out on July 1st. At any rate, I think that going forward, we're going to see tremendous growth again this year and into next in manufacturing plants, specifically computer, electronic, electric plants, as Census calls them. These are the semiconductor fabs that lately have been getting huge grants from the Federal CHIPS Act, and also transportation equipment. There's been some pullback and a lot of worry about whether new EV manufacturers will be able to follow through on their construction plans. But for now, there's clearly a lot of growth happening in the category of EV and battery and component plants. On the third positive would be the power and the infrastructure categories, such as highway and many of the transportation categories. As you can also see, education has been quite strong for both primary, secondary, and higher education. I am concerned that higher ed is going to taper off as we see decline in enrollments and I think growing skepticism about the value of incurring huge debt to send kids to colleges, particularly with the current unrest. Well, let me wrap this up with a quick summary of where I see the outlook for now. I think the economic recovery will continue through this year, but I also think interest rates are going to hang at close to current high levels. I don't expect the Fed to cut its short-term interest rate target until December or maybe even 2025. And I think mortgage rates are currently running over 7% for the 30-year fixed rate are also likely to remain at a level that will discourage many home buyers. Nevertheless, single-family home construction will pick up from the extremely low levels of a year ago. But multifamily, warehouse, and office construction are being hit hard by tightened lending standards and rising vacancy rates. However, those things will be outweighed by strong growth in data center and manufacturing construction, and hopefully, finally, getting a lot of the money promised by the Infrastructure Investment and Jobs Act, the CHIPS Act, and the Inflation Reduction Act. So the biggest challenge for contractors will continue to be labor availability. Paul, let's skip the next slide and just go to a map to wrap up. This shows where population growth occurred last year. It did match nationally what we saw in 2018, 2019, about 0.5%. But we had 8 states that lost population, growth concentrated in the Southeast and Texas and the Intermountain West. And I think that this will continue for some time. So with that, let me turn it back to you. But I do invite anybody who's interested to get my data digest, my weekly summary of economic news relevant to construction. Just email me at ken.simonson@agc.org. Go to our website, agc.org, for lots of other material. And thanks for having me back, Paul.
Of course, Ken. Thank you. And folks, if you don't receive Ken's weekly data digest report from the AGC, I highly recommend you sign up for that immediately after our webcast today. In fact, we're going to share a link to where you can sign up for that later in our program during the Q&A session. Next, I am very pleased to welcome for the first time to this webcast series, Construct Connect's Vice President of Content Acquisition, Morgan Stenson. Morgan joined Construct Connect in 2010, and she is a seasoned industry leader with well over a decade of experience in the construction information space. As the head of the content team, she has been instrumental in shaping its structure and implementing robust processes to ensure comprehensive coverage of both public and private sector projects. Welcome, Morgan. We're so glad you could be here today.
Thank you so much, Paul. Very excited to be here as well. Of course, I'm here representing Construct Connect, where I lead our content team. Our team works very diligently with numerous industry professionals to curate and verify detailed project information from conception through to award. Today, I'll be focusing on the commercial construction project trends from Q1 plus April, comparing them to the same period in 2023. Let's dive into the details, and we're going to start with some bidding trends here. So in the first quarter of 2024, when we examined commercial bidding trends over the last 5 years, we observed the U.S. bids are performing better than in 2019, 2020, and 2021. However, there is a noticeable decline compared to the surge we saw in 2022, a post-pandemic year when many previously postponed bids resumed. In 2023, bidding activities began to normalize, and this stabilization appears to have continued into 2024. Now let's dive into the Canadian bid volumes on the next slide. All right, in Canada, the bidding trends represent a distinct pattern from the US. After rebounding significantly from the lows of 2020, there's been a consistent growth compared to 2019. However, we've observed a mild retraction in bidding activity in more recent years. The shift from 2023 to 2024 reflects a strategic adjustment at Construct Connect how we categorize service, maintenance, and supply projects. Despite the slight decline in overall bid volumes, there was an increase in general building and civil projects, contrasted by a decline in service, maintenance, supply bids. So next, we'll shift over to the new trends in the U.S., new project trends. All right. Our team diligently enters new projects at both the planning and bidding stages. In 2024, the volume of newly created projects is on par with 2019 and 2021, and it shows a slight increase over pandemic-impacted year of 2020. Though we're slightly behind in 2022, there's a notable 7% increase compared to last year. You might recall from my previous slide that the bid volumes were flat year over year, raising the question, why the increase here? This data includes newly created planning projects in addition to bidding projects. And so far in 2024, we've observed an 11% increase in planning projects compared to last year, reflecting renewed focus on initiating new developments. On the next slide, we'll discuss U.S. project year-over-year project value changes. All right. So as we examine the construction spend, there's a notable uptick in both civil and building segments across the U.S., despite flat bid volumes, and of course our observed planning increase, which we discussed earlier. This surge, combined with the rising cost of construction due to various economic factors, has led to an increase in year-over-year value of construction projects through April. We're very interested to see if this trend is going to continue throughout 2024, so this is something that we'll be keeping a close eye on. Moving through the next few slides, I'm going to review building uses in which we have seen both growth and declines in the United States and Canada. All right. In the U.S., we're witnessing a noticeable resurgence in sectors like retail and restaurants. Industry professionals report an upswing in activities such as grocery stores being constructed and companies repurposing existing locations from one brand to another. Additionally, there has been a rise in construction for educational and medical facilities. Notably, several experts suggest that healthcare could be a prime candidate for repurposed spaces, which may be contributing to this increase. On the next slide, we're going to explore sectors where there has been a decline in activity. In the United States, we continue to observe declines in office building use, and recently municipal projects have started to retract. This downturn is largely driven by the escalating cost of construction, and the same budgets that once sufficed are no longer adequate, leading to some projects being temporarily put on hold. Additionally, while warehouse and distribution centers were previously areas of growth, particularly with major companies initiating new facilities, we've noticed just a slight decline into the start of this year as construction has commenced on some of those large-scale projects. The initial surge in activity is just slightly tapered off. Coming up next, we're going to shift our focus to Canada, and we're going to review the sectors that have experienced growth there. In Canada, we've observed significant growth in certain sectors. Educational and municipal buildings have seen an uptick, as have multi-residential projects. The increase in multi-residential projects can partly be attributed to Canada's current housing shortage, highlighting a responsive surge in construction to meet this demand. Additionally, there have been noticeable year-over-year increases in transportation terminal projects, reflecting ongoing investment in infrastructure. Next, we'll shift our focus to the sectors that have experienced some declines. Right. Similar to the U.S., what we've observed in the U.S. is that Canada is also experiencing a decline in office projects. In addition, there's been some noticeable decreases in fire and police projects as well. Most of this due to budgets, we spoke to earlier about the cost of construction now being higher than it once was, and that's why we believe we've seen a decline in this building use. So overall, we have some similarities between the US and Canada, but definitely some very distinct markets. So Paul, back to you, and thank you so much, everyone.
Thank you so much, Morgan. Great insight again from our market research teams here at Construct Connect. I'll remind everyone, if you want to ask a question of Morgan about any of the trends we're seeing in the intake of construction data that we're pulling in from our teams, ask that question in the Q&A panel of your webcast screen. Our next panelist is Construct Connect senior economist, Michael Gukas. Michael started in construction economics as a leading economist for the Ohio Department of Transportation. He then transitioned to manufacturing economics, where he served 5 years as the chief economist for Gardner Business Media. He covered all forms of manufacturing, from traditional metalworking to advanced composites fabrication. In early 2022, Michael joined Construct Connect's economics group, shifting his focus to the commercial construction market. In his short time with Construct Connect, Michael has developed new ways of looking at our construction data, including the very popular Project Stress Index, which measures trends in delayed, abandoned, and on hold projects. Good to see you again today, as always, Michael.
Thank you, Paul. All right, well, we will dig right in. So I am very pleased to present to all of you our summer 2024 starts forecast. And this one here, I'm going to start just from the top down, but 2024 residential remains in the strong single digits from our prior outlook, so that's good. But underlying this was a substantial reduction in our multifamily outlook. It was at 6.4% for 2024, and now it's at 0.1%, so about flat. This will be partially offset by some improvement in our single family outlook. For non-residential building this year, we are now at negative 4.8%. That is down further from the negative 2.4% outlook we had at the start of the year. For total non-residential, that is at 3.3%. That was, I apologize, at 3.3% at the beginning of the year, and now we have reduced that slightly to about plus 2%. This is, I think, fairly copacetic with what we've heard from the other speakers today. U.S. grand total, that starts forecast has now been lowered from 4.5% to 3.3%. And so in general, we are tempering a lot of our forecasts just given the macroeconomic conditions out there that so many of you are already aware of. High level downward revisions. So if we look below into our subcategories, one of them that I would point out is commercial. We were at a 9.9% forecast for this year. That has now been reduced to 2.3%. Not everything I have to say, of course, is on the downside of this. There are some good positive forecast changes out there as well. We continue to see mega projects, for example. Those are projects in excess of $1 billion in value. They will play a significant role in total construction. Right now, we see them tracking at about 15% of all first quarter 2024 spending. So that's very good. Total engineering has been revised higher. Last quarter, we had forecasted 12.7%. We are now a little bit more bullish on that segment at 13.2% growth. Total institutional has improved as well. It was down almost 4%. We've raised that a little bit, but then to keep total high, and then if we go to the next slide, Paul, I want to share with this group our subcategory outlook. So within the major segments that I just talked about, we can see the dispersion of results here. And I think it's really important to show this because, again, where or how you play in the construction market is going to provide you a very different experience this year, depending on where you're playing, in a sense, or what you are focused on doing, right? And so we see at the top of this miscellaneous civil. Miscellaneous civil is something I'm going to point out what that is exactly. It includes power infrastructure, parks, landscaping, railroad and subway work, military non-building, athletic fields and courts, swimming pools, civil demolition work, electrical work, fencing, machinery and supplies, tunnels, oils and gas pipelines. So there's a lot in that category that I just want this group to be aware of. Some of these subcategory groups will be heavily impacted by public spending. And I should note that if we look at how much money the government is bringing in through sales tax and various other receipts, that amount is down 2% since hitting a peak in the first half of 2022. So we've gone not quite 2 years now where the government is actually seeing a decline in the real value of the amount of money that they're bringing in and can turn around and then spend without, of course, going into deficit spending. In this slide here, I also want to point out that office will be challenged by the challenging market forces already talked about, the enduring work from home trend. I think Ken or Kermit talked about that. And then also interest rates, of course. Nursing homes and assisted living will be impacted by demographics. But then also we need to think about more nuanced things, such as the legislation that will change how many registered or qualified healthcare workers are needed per the number of residents. And that could have a very big constraint on the number of usable nursing facilities. So these are some of the things that our group continues to look at very carefully. Next slide, Paul. The key starts and takeaways. So in this, I will not read this slide, but these are some of the big points I want to bring to your attention. As you read our starts forecast this quarter, I want you to consider that each subcategory, again, has its own market cycle timing. Some categories rise early in an economic cycle or in an economic boom, while others are late bloomers during a boom or just a business cycle in general, right? So if we think about it, right, government offices and industrial labs, school labs, et cetera, they are coming off of historically high 2023 results. So some of that slowdown is simple business cycle things. Our residential outlook, well, we expect that to nadir here to bottom out in 2024 before turning higher. So we're at the bottom of that business cycle. Hotels, shopping, and amusements, they all reached lows in recent years. And we believe we are primed to see long-run growth there for you. The next one. So as I was pointing out, right, there is the business cycle, and then there are certain shocks to those cycles, right? Some of those shocks can be good, some can be detrimental, right? But the point being that not all those shocks are going to lift all of our subcategories in the same way. And so firms out there, our audience, needs to be careful and consider about how they're picking their verticals, or better yet, pick multiple subcategories or verticals that you want to serve in order to reduce some of this business risk and some of the volatility, right? And so I have listed here a couple of the big drivers of reshoring and national security issues. Those are driving a lot of the mega projects. And then, of course, with mega projects come the ancillary projects around those. You have energy and the electrification of our economy. That, we believe, will continue to be a very strong trend for many of the verticals that are either directly or indirectly benefiting from that transition. We have the growth of civil projects. And then on the other hand, of course, we have interest rate sensitive markets. And we've already talked about office spaces and other places where it's the cost of financing can turn your return on investment predictions upside down, or simply fail to bring those returns to the necessary level to make that project profitable. Next slide. On the Canadian side, lots of things to talk about here. Our grand total outlook is now 4.4%, sorry, negative 4.4%. That is significantly down from our nearly 8% outlook that we had at the start of the year. This revision was caused by significant decreases in our total engineering outlook. That outlook started the year at plus 21%, and now it's negative 9%. Every engineering subcategory, unfortunately, is down now. Total residential was at a 4.1 expected growth rate for the year. That is now negative 2%. And we have to remember that residential makes up about 1/4, a little more than 1/4 of the grand total spending here. Neutral is institutional. That has not changed, but it does remain challenged. And then on the good side, to end on a good note with this slide, we have to remember improving commercial conditions. Conditions were expected for the beginning of the year for this year, commercial was expected to be down 2%. we now have a 2024 outlook that is plus 2%. So that's good. And of course, for more information, I threw a lot of information here at this group. You can go to our website, and under our economic resources, you can download the latest PDF of our construction starts and really dig into these numbers in detail. Next slide, Paul. So our project stress index, again, something that we are very excited to be bringing to the market. This is a index that looks at the challenges facing projects from their ideation to really their groundbreaking. So what is happening to projects, the success of projects, I should say, as they move from the very early blueprint stages onto final bid. And we can see here that our index begins in 2021. So 2021 is a value of 100. And what we're seeing essentially now is that overall conditions are about 30% more difficult now than they were 3 years ago. That has, as you can see, been, I think, largely a result of the rising interest rate environment that has challenged all of the categories of construction that we're monitoring. Next slide. Of the three components that make up the PSI, abandonments, I would argue, is probably the most severe form of project stress. And unfortunately, what we have seen since the third and fourth quarters of 2023 is that abandonments really, for the first time ever, are sustainably lifting the index in a way that it has not really ever done before, except for a brief period in early 23. You can see that small orange spike there that was fairly temporary. But prior to that, in more normal times, I would argue, we normally don't see abandoned project activity taking the lead in our index. And so this, I think, speaks to a lot of the challenges that have already been spoken to. It just simply quantifies some of that challenge. And then the other thing that I would pose is that how do we as a community deal with this problem? In other words, what can we do operationally speaking so that if a project that we are depending upon or hoping to depend upon is either put on hold or is abandoned or otherwise challenged, how can we operationally prepare ourselves to handle those hiccups? Next slide. And then lastly, just finishing up here, I want to talk briefly about this buy versus build calculus, right? As we already talked about, the all property index, this is, I believe, the same one that was spoken of earlier, just indexed a little differently here. We're seeing declines in the existing value of construction, while at the same time, of course, the actual cost of building it, as both Ken and Kermit pointed out, is much higher than it was back in 2020. So the challenge, of course, is how do these dynamics affect the demand for new construction versus buying something that is existing and then renovating it? And certainly our renovation numbers have suggested that there's a lot of opportunity in the renovation market renovation opportunity there for us as a construction community. So those are the major points. The other things, of course, as you can see here, top of the list, the cost of financing is so much higher now than it was. And it's not just from the banks, but it's also to insure the property as well. Just all of the costs associated with financing new work is just tremendously higher than it was. And so we need to continue to understand, how long will this higher for longer rate environment that Ken was speaking about last? And what can we do in the interim to manage that? Next slide. And then this part here, just speaking to, again, what is happening from a banking perspective. Banks are by no means excited about this part of the market, the CRE part of the market right now. You can see here that the number of banks increasing their loan standards for CRE loans is just about as high as it's been in recent history, aside, of course, from a brief surge during the very beginning of COVID, but we are seeing the banks in some other areas like C&I loans beginning to soften a little bit there. Again, the whole reason I'm pointing this out is because those firms that are really dependent on financing for both operations and for those owners and developers looking to initiate new projects in the interim period here. There's going to continue to be some difficulties around that are, as I've mentioned before, tempering our outlook. Next slide. So, a couple of considerations for this group, right? How are we going to play the landscape, right? We've talked about the distribution of outlooks here, everything from other civil to, our office space outlook. So how do we play the game? Where does your revenue strategy take you if you play a diversified game and look at serving not just one subcategory, but multiple categories? How will your firm manage or respond to projects that fail to cross that finish line, that are unexpectedly put on hold or delayed, or worst of all, abandoned, right? How can we have some extra work in the pipeline there, or at least hedge those bets, right? And then lastly, dealing with higher for longer interest rates, how do we, as a community, respond to that drag on construction demand? Thank you, Paul.
Thank you, Michael. Great information, and appreciate you being here. Next, I am always happy to introduce Construct Connect's Chief Economist, Alec Carrick. For the first 13 years of his career, Alec worked for the Canadian Institute of Steel Construction. But for almost 4 decades now, in fact, for 39 years, he's been with the company that has become Construct Connect, first as Canadian Chief Economist, and then additionally as U.S. Chief Economist. He has written thousands of articles and delivered countless presentations on the world, U.S., and Canadian economic and construction outlooks. And Alec has a strong social media presence with tens of thousands of followers on X, formerly Twitter, and LinkedIn. Make sure you follow him on those platforms. Great to see you, Alec, as always.
Thank you very much, Paul. And pleasure to be here. It's great to know that there's so many people have joined us today. The first slide then, if we can. Michael and I have had the privilege of appearing on the Construction Record podcast. And the most recent one we did, we talked about how general contractors could diversify, because there's a lot of uncertainty in construction these days. And some of them are obvious by type of structure, public versus private, new versus renovation, modular versus traditional. But there hasn't been a lot said about geographically. So next slide, please, Paul. So what I'm going to do today is I'm going to talk about some of the numbers on how the United States and Canada are changing fairly dramatically in terms of some of the population shifts and some other key indicators. This first slide looks at the state populations and the national population. And over the last year, the two key numbers for the U.S. as a whole are a population growth rate of 0.5%, and in addition to the resident count of 1.6 million. Now, among the states, there are 4 states that account for really the bulk of the resident count. 1 in 3 Americans lives in either California, Texas, Florida, or New York. And it's Texas and Florida where there are very significant increases in population, 1.6% compared to that 0.5% for America as a whole. And in California and New York, there are actually declines in population. So Florida and Texas are right up there. The only other state with a faster rate of increase in the past year was South Carolina at 1.7%. Next slide, please, Paul. And here what I've done is I've looked at the 20 metro statistical areas for fastest growth over a 3-year time period. And there are 54 cities in the U.S. with populations of 1 million people or more each. And these are the 20 with the fastest increases. And I've color-coded it here. And on the left, and the reason for doing this is I'm not sure that people realize the degree to which the South is surging ahead. And the first color coding is to the far left. And all those cities are in the South. And there's 14 of them that are shaded sort of pink there. And this is the South is defined by the Census Bureau. But I think most people would consider that Phoenix is also in the South, and Las Vegas, and Tucson, Arizona. They're called West by the Census Bureau, but they're really in the South. So of the 20 top cities, 17 of them are in the South. And then the other shading on this table is for the 3 states, Texas, Florida, well, 4 states, I guess, Texas, Florida, and the Carolinas. And you can see that that's where most of the population increases have been occurring. Next, please, Paul. And looking at the level, the increase in level of population, it's the same thing. There's 15 top cities, and 13 of them are shaded for being in the South. And Phoenix is in the South, so I know it says West there. But 14 of the 15 fastest one-year increases, this is the level of population, are in the South. And again, you can see how dominant Texas, Florida, and the Carolinas are. Next, please, Paul. Now, there are 19 cities or CMAs where the population has declined over the last 3 years. And 19 out of 54 cities means that there's 1/3 of the major cities, or the cities of 1 million population or more, where there have been declines. And it's the cities that you sort of know about and you expect to be on this list. It's Los Angeles and New York and Chicago and San Francisco and Pittsburgh and some others. Now, some of them have stabilized in the latest year, but there's still quite a few cities. So again, what we're talking about is this shift that's taking place in the country. Next slide, please, Paul. And obviously, you'd want to see what the population change is related to GDP growth. And I looked at the GDP numbers, the quarter-to-quarter percent change annualized for the 20 largest cities in the United States, or 20 of the 20 largest states in the United States, and took the average GDP growth over the past 2 years. And surprise, surprise, it's Florida and Texas at the top of the list. And both of those states have GDP increases that are almost double what the GDP increase on average, quarter to quarter, has been for the country as a whole. Next slide, please, Paul. And then looking at our own Construct Connect's start statistics, they're remarkable. I think they're really tell quite a story, last year anyway, that Texas, by dollar volume, had more than double, or almost double, the dollar volume of construction starts, total non-residential construction starts, as California. Texas has a population of 31 million and California 39 million. And what kind of projects have been taking place in Texas? Well, that's just a real grab bag of projects, but it's also runs the full gamut. It's things like LNG exporting facilities, and the chip making plants, and its giga truck plants, or at least the one by Tesla, and battery storage units, and that's also Tesla. Next slide, please, Paul. And in terms of the subcategories of total non-residential starts, Texas was more than double second place California in 2023, and about 50% higher than second place California in terms of heavy engineering starts. Next slide, please, Paul. Now let's look at housing starts. And the way that you measure this is in terms of residential permits in units. And again, we see some of the dramatic shifts because 3 of the 5 top cities in the country were in Texas. And those housing start numbers for Houston and Dallas-Fort Worth are huge. Those are really high numbers for permits or housing starts. Next slide, please, Paul. Coming to Canada then, remember that I said that the US growth rate in the latest yearly numbers was 0.5%. Canada's population increase in the latest annual result is 3.2%. And I said that the US had an increase in resident count of 1.6 million. Canada's increase in resident count was 1.2 million. Not that far off. Generations of Canadians have grown up believing and using as a rule of thumb that the United States population is 10 times greater than Canada's. Well, if you go to the population clocks on the internet and you do the simple math, you will find that that ratio now is approximately 8 to 1. It's actually 8.3 to 1 because the population of Canada has been increasing so rapidly and so dramatically. Now in Canada, it's Alberta that's sort of the comparable province to what Texas is in the United States. And the country as a whole increasing at 3.2%. Alberta's latest annual increase was 4.4%. And among provinces, the next was Ontario at 3.5%, then British Columbia at 3.3%. Next, please, Paul. And here's the population change in Canadian cities. And the city that really stands out is Toronto, of course. And there's 3 cities in North America where the increase in population and the annual increase in population the last couple of years has been 100,000 or more. And if you think about an increase of 100,000, that means a lot of construction. Now, here's another statistic, and it will be particularly of interest to Canadian registrants, because this kind of blows my mind. The population of Toronto, not including outlying regions like Guelph and Barrie and Oshawa, the population of Toronto, compared with the 2 next biggest cities in the country, Montreal and Vancouver, is 93%. Toronto is almost the same population as Montreal plus Vancouver. Next slide, please, Paul. And housing starts in the Canada's biggest cities. It's Toronto that's the leader. But last year, for the first time that I can remember, Calgary replaced Montreal in 3rd place. Montreal was bumped to 4th. Vancouver was 2nd. And if you look at Canada and the United States combined, housing starts in Toronto would have placed 3rd overall, although still considerably behind Houston and Dallas. And Vancouver would have been 8th overall. Okay, so that's the end of looking at just the demographics, and I've got some other comments about construction and what to expect. What are the big issues over the next year and a half? Well, one of them is that politics matter. In the United States, there's the presidential election coming up in November. And in Canada, there's likely to be a federal election in 2025. And just to give you a couple of examples here, if the incumbent parties lose, there's likely to be a considerable scaling back of the energy transition efforts that have occupied our governments over the last several years. So that's one. A second point is that the central banks in both countries are likely to find that they no longer have quite the independence that they once had. And there's a whole bunch of other things where politics count. So a second major issue is that everything is more expensive. And we're all waiting for inflation to come down and interest rates to come down. Now, do you have any idea what the biggest line item or the biggest year-over-year increase was among line items in the U.S. Consumer Price Index in March? Well, surprise, surprise, it was motor vehicle insurance, plus 20.2%. And some of that is probably due to the cost of repairing electric vehicles. And there's currently a backlash against electric vehicles. And we'll see where that goes. Now, in terms of the construction sector, I'm not sure whether it was Ken or Kermit who mentioned it, but there's an increase in material costs since before the pandemic of about 40%. And if you graph the producer price indices for the various components that go into construction, lumber is back to sort of where it was before the pandemic, and that's because housing starts have fallen. Steel is off its peak, aluminum's off its peak, copper's off its peak. I'm talking about the long-term picture on these PPI indices. But cement, ready-mix concrete, and gypsum, they're all still at their peak. And then there's a whole range of products that you look and you see what the trend line was before their peak, and you extend out that trend line, and where are we now? Well, insulation materials is up there. The really big ones that are way above their extended trend lines are things like paint and glass and lighting and plumbing fixtures and heating and cooling equipment and escalators, elevators, and construction equipment generally. So the prices of these things are way high, and they're likely to stay there unless there is a really serious contraction in the economy. So that was my second point. Everything's more expensive. And the third point I would bring up is about what projects are in the pipeline. Well, we've heard today about a lot of them. There's certainly still a lot more data center projects. Funnily enough, some of those are going where you wouldn't expect them, like Indiana and Ohio. Columbus, Ohio is becoming somewhat of a high-tech center. And railroads and roadways. Texas has a huge road construction program underway. And as for railways, well, Brightline just completed that connection between Miami and Orlando in Florida, and it started work on a high-speed rail link-up between Las Vegas and Rancho Cucamonga. And then also amusement centers. I'll be finished in less than a minute. Amusement parks. There's amusement. Disney and Universal are spending billions of dollars, and then there's sports stadiums. So on the theme, closing on the theme of entertainment projects, I just have a little thing I want to read you. Continuing with the entertainment theme and including this event. It's all live theater, folks. You're both actors on the stage and observers from seats in the audience. I will soon be retiring or semi-retiring, and I'm counting on you to keep the lights on. I want to acknowledge and thank Ken and Kermit for their longtime companionship on this webcast, and to offer a shout out to relative newcomers, Michael and Morgan. And now back to our excellent and snappily dressed moderator, Paul, for question period.
Thank you, Alec. I want to make sure I had to stand on my tail. I want to make sure you see my pocket square that I wore in honor of you, Alec. Thank you for being here. Thanks for that information, Alec. Fantastic, as always. Always great to hear from you. Okay, I've got a couple of very quick items I'm going to go through very quickly so we can get to your questions. I want to make sure you're aware before we jump into our questions, you can sign up for our monthly construction starts report and our quarterly forecast report. And I think there should be a link now in a banner scrolling across your screen where you can go to sign up for these economic reports. Otherwise, you can also, oh, there it is. Look at that. That's amazing. We have this wonderful banner now on our new webcast platform. Also, keep an eye on that banner throughout the Q&A session. We'll be sharing other links, including links from the AIA and the AGC, where you can find more information from both Kermit and Ken. We have our economic resources page there. There's a shot from it on your screen right now. We'll share a link for that in a few moments. A bunch of resources there, too many to list right now. And then also we're going to be sharing a link. Keep an eye on that banner again for a new labor ebook. You've heard a lot about labor shortages. There was a labor crisis before the pandemic. There continues to be labor shortages across construction. You can find even more information about those labor trends and great things to think about, strategies to overcome some of those labor challenges. There's some guidance in this ebook as well. It's not just reporting the bad news that most of us are already aware of. It's got some great strategies in there. So make sure you check out that ebook on labor challenges from Construct Connect. Okay, now, one more information slide, but I hope it's worthy because we would love to meet you. Please come and say hello to us. If you're planning to attend the AIA 2024 Conference and Expo in our beautiful nation's capital next month, please come say hello at booth 2629. And you will not want to miss Michael Guka's presentation at the AIA conference area. That's going to be on Thursday, June 6th, 10:30 a.m. in the Zone Theater there of the Conference and Expo for AIA. We will also be at the conference of the American Society of Professional Estimators, September 13th and 14th in wonderful Cincinnati, Ohio, home of Construct Connect headquarters. Our Chief Product Officer, Jen Johnson, will be presenting there. Are you planning to attend the Plumbing, Heating, and Cooling Contractors Conference in beautiful Birmingham, Alabama? Go Blazers! October 7th and through 10th. Please stop by booth number 609 and say hello to us there. And as always, we'll be attending the Building Show in Toronto this December, where both Michael and our Chief Technology Officer, Doug Dockery, will be presenting. And you can see the details for that there on your screen. Okay, as we start our Q&A session, now we're trying this for the first time. I want to see if we can get up Jake, our wonderful director. Help me see where the poll results are, if we can share those on the screen, or if I'm able to see those. Maybe we'll work on that in just a minute. Let's get the questions going here. If we want to bring our panelists on stage, let's start with some questions. Kermit, okay, visit the polls view. Let's see, go to polls tab. Let's see We can see what the polls are. Okay, the biggest concern about the construction economy, it looks like overwhelmingly, it is financing, or a substantial lead there, financing and interest rates. Financing and interest rates did appear. You can see the results if you click on the screen, the little panel that just popped up in your screen. My biggest concern about the construction economy over the next 6 to 12 months is financing and interest rates leads those other options. And I'm really interested in this one. Market conditions have influenced my business too. Looks like the largest one is actually none of the above. So maybe there's some other options here, but second comes in as diversify projects by building type. That's guidance we've heard from our senior economist, Michael Gukas, over at least the past 12, if not 24 months, about diversifying your portfolio and looking at other project types. Okay, let's jump into questions. I'm going to shoot the first question over to Kermit Baker. Kermit, your consensus forecast results, you just released those a few months ago. I think you mentioned the next ones are coming out, those are coming out this summer. A lot has happened in the economy just since you published those consensus forecast results a few months ago. You got the next one coming up in summer. When your mid-year update comes out, what changes do you expect to see in that forecast?
You're absolutely right, Paul. A lot has changed since we polled the folks last time. I would say number one on the list is that, at the beginning of the year, there was a lot more optimism about where interest rates were going. I think the consensus was we would see 4 or 5 rate cuts by the Fed in 2024, and that's been diminished substantially to, gee, will we see any at all? And if we do, it probably is going to be 1 or 2. So I think the prospects have dimmed. Michael talked about how the Construct Connect forecast has been lowered. Construct Connect is obviously one of the members of our forecast panel, so their vote is in that the number's going to be a bit weaker. And I think that's probably going to be the consensus, is that the numbers were not strong when we pulled folks at the beginning of the year, and probably going to be a bit weaker when we pull them again over the summer. I think particularly on the commercial side, very interest rate sensitive. I think probably those forecasts will go down. On the industrial side, I think they'll probably be about stable. On the institutional side, I think it's some possibility maybe the forecast might even be a bit stronger than they were at the beginning of the year. But as a whole, I think the forecast is probably going to be just a little bit weaker than they were.
Fantastic. Thank you, Kermit. Let me ask, I've got a question for Ken here. Ken, with I've got so many I'm scrolling through here, y'all. Sorry, bear with me, folks. Ken, I'm going to ask you to move into this question about mega projects, because that has been a theme. We haven't talked about it as much this session as I remember the 2 sessions we had in May and November of 2023. We haven't talked about mega projects as much. Now, if mega projects have been propping up, especially the manufacturing sector, think battery and chip manufacturing, what, if anything else, if there is anything else that could help that if we start to see diminished levels of these mega projects? I mean, it only takes a handful of these each year to really boost the numbers in construction starts. But for example, in Georgia here, we've recently had we've had a large electric vehicle plant go on hold after they've already broken ground. They're doing a lot of the civil work there. It's going on hold. So if we start to see a slowdown in these mega projects, what else is out there that's going to help maybe hold up some of our construction starts looking forward?
Well, first, I think we're going to see continued growth in the number of data center projects, and these keep getting bigger. I just saw an announcement of a multi-billion-dollar data center project where previously they were under $500 million. So that category is going to keep growing. But so I think many other types of manufacturing are going to be popping up in the U.S. as firms bring production back here, either to get away from potential and actual conflict areas, or to qualify under the Build America, Buy America Act, to shorten those supply chains that were so hung up in 2020, 2021, and then perhaps to serve new industries. There's a lot of interest in sustainable aviation fuels, in hydrogen production, perhaps carbon capture and storage. So a lot of manufacturing related to various aspects of renewable energy or decarbonization.
Fantastic. Thank you, Ken. A question for Alec here. Alec, you spoke a lot about population shifts, about migration within the U.S. What are impacts of certain parts of the country? What impacts certain parts of the country to perform different than others in new building activity? And I would say, because you spoke, I would think maybe your first answer, I'm guessing, is maybe some of these population shifts. What else is impacting growth and new construction in different parts of the country?
Well,
I should say both countries, U.S. and Canada.
Yeah, well, if you're looking for what's impacting it, it's a bit of a mystery, because people are leaving California. You can understand, because of the high house prices, and it's also weather-related events. You can't. There's certain numbers of people that really can't get insurance, and so they're moving to the interior, and it's a lifestyle thing too. I mean, people have learned during the pandemic that they don't necessarily have to live where they thought they had to live, so they can move in from the interior. But then you've also got the really strong population increases in Florida and Texas, and it's not like those places are immune from severe weather events. So that's kind of an odd one. So I'm not entirely sure what's going on there. And in Texas and Louisiana, again, it's hard to get homeowner insurance to protect yourself against that sort of thing. But the other things, of course, are labor costs. Labor cost is a huge part of it. Like the South traditionally has cheaper labor rates, so that's yes. One of the things that's motivating it. And the sun. If you're a sun worshiper, you want to go where things are warmer. And so there's a whole bunch of factors, and what's in there's and it has all kinds of ramifications too, because I'm still very much fascinated by how the United States still has more single-family housing in most cities than multifamily housing, as a general rule. And that's certainly not the case in Canada. Like the major cities in Canada, multifamily as a percentage of total units is 85 to 90%. And in the United States, except for the cities like Seattle and Boston and San Francisco, where they do have more multi-unit starts than single-family starts. And a lot of that seems to tie in with young people who are entering the marketplace and want to get into the high-tech sector and STEM industries and so on. I showed those numbers on Houston and Dallas, and those cities are still predominantly single-family markets.
Right. But, I want to pivot on that for just our last question. We've just about run out of time here. I want to throw this, if we can address this very quickly. I'm going to kick it back. I haven't been able to ask a question of everyone, but there's an important question that's come in from one of our viewers today. I'm going to send this to Kermit, and it's picking up on what Alec was just talking about. We've heard a lot of information. We've gotten a lot of questions today, actually, about multifamily housing in our Q&A session here. Could you, Kermit, elaborate with your experience in housing? Can you elaborate on the multifamily outlook that you've seen? Maybe some ahead of time results or things you're hearing as results from the consensus survey are coming in. What is your outlook right now for North American housing shortages and how multifamily plays into that?
Yeah, let me just give a couple seconds of background on that too, Paul. Multifamily residential was incredibly strong during the early days of the pandemic. Looks like we overbuilt a bit. And so architects that serve that sector have been reporting very weak conditions for the last 2 years or so. We have a pretty significant housing shortage in the country. And particularly with mortgage rates and house prices as high as they are now, very difficult to buy a home. And I think renting is, even with high rents, a more increasingly popular alternative. So, I think this year is probably going to be another off year for multifamily residential, but I think the prospects are strong moving forward. I think we'll start to see the market turn around in 2025, and I think we're probably going to see a couple strong years for multifamily following that. So I think the prospects after about another year or so are looking pretty good.
Okay. That's great. Thank you, Kermit. I'm sorry I didn't get to ask all the questions. We had so many great questions, and I didn't even get around the whole table to ask a panelist each question, but that's unfortunately all the time we have for today. I want to thank all of our panelists once again, the AGC's Ken Simonson, Kermit Baker from the AIA, and my ConstructConnect colleagues, Morgan Stenson, Michael Kukas, and of course, the incomparable Alec Carrick. Many thanks to all our friends at the American Institute of Architects and the Associated General Contractors of America for their continued partnerships and collaboration on this and so many other initiatives. We have an amazing group of people here at ConstructConnect who work very hard to produce and promote this webcast series. Jake Elmhorst is our webcast director. My sincere thanks also to Dawn Reiner, Brittany Phillips, thank you, Brittany, Haley McClatchy, and Marshall Benvenisti, Jen Johnson, and Anthony Gariso. Thanks for your continued support. And thank you so much for joining us today. Please keep an eye out for the fall 2024 edition of the Construction Economy Outlook webcast series coming in November. Until then, this is Paul Hart with ConstructConnect, wishing you a very happy and very prosperous summer. Let's keep building.